All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by repeat guest Mike McGlone, who is, of course, the Senior Macro Strategist at Bloomberg Intelligence. Okay, got that right. Mike, thanks for coming back on.
Oh, thank you, Michael. I appreciate your Florida tan. It's good to be back on.
I would love to, maybe we can start off with your thoughts on the debt ceiling, which has gotten a lot of, frankly, airtime, but it's gonna inform some questions that I'm going to ask you later on about Treasury positioning and gold and silver and commodities. But I would love to, before we dive into the details there, like, what are your sort of thoughts overall on the debt ceiling?
I think there's one key way to end this impasse to make these two great parties come to terms and have an agreement. And that is when they get up in the morning, they read in the Washington Post, New York Times that the stock market's going down a lot because they haven't agreed. There might be a default. They'll come to terms. Unfortunately, I think that's going to be the key thing right now. To wake up one morning and find out there's been an agreement would be delightful. We'd get a pretty significant risk on rally out of that, Bitcoin and cryptos in the stock market. But I think that's the unlikely scenario. I think it's going to be more like 2011. You get that 20% drop in the stock market, and then they all come to terms. The key thing that's happening, this is such part of what's going on, Michael. So what do we have to look forward to politically is we have an election coming up and two candidates, both most people in this country do not want to see run again are the leading candidates for their party's nominations. And then that's very depressing, and that's why I hate to use that word, but we're heading towards a tilt towards not just a recession, but a significant depression type scenario economically, and that's just part of it.
Yeah, I think we try to stay away from politics on the show, but I think we could pretty safely say Trump versus Biden election, that is just a bummer for the country in general. I don't think anyone feels like they're
Yeah.
winning there. That's
What's that
I'm
gonna do for
just a
the
little
general feeling? It's already going bad.
Yeah, I'm in agreement with you. It just feels like, we've got 350 million people in this country. I feel like we could put up two more interesting candidates. But so basically is your sort of take then eventually, look, it's in no one's long-term economic interest here to default on the debt soft or otherwise. So eventually there's going to be a lot of hand wringing, but eventually we're going to solve this. And kind of the most likely scenario is that the market panics a little bit up to that. And there's sort of like a 20% kind of dip, but then we eventually make up for that. Is that sort of the base case for you?
Um, my base case is we will go down that 20% in the equities, regardless of this the oxymoron of default in U.S. government. That should never be something to be said. Maybe it'll be a delayed payment, but it'll all be worked out. And everybody will get their U.S. dollars. They may print more, but we are seriously tilting towards a recession. The Federal Reserve is still tightening, and the job winning out of Fed governors is significant. You cannot, don't fight the Fed has been one of my main mantras for well over a year, and it still is. That the key dichotomy you see is Fed fund futures price for from now, right now to the end of the year, about 70 basis points of cuts. And virtually every economist, our chief economist, Anna Wong, our chief strategist, Ira Jersey, and most of the Fed governors said, we're not going to be cutting rates. Saying that, it means there's only one way for that really to happen, for the futures market to be right, and that is for the stock market to go down and make it happen, unfortunately, which might be led by Bitcoin. So the situation we're in right now, I see as mostly risk, lose for risk assets. And you're seeing that in commodities. There's significant deflationary forces showing up in commodities. So I look at the politics are all part of it. To me, it's the most overwhelming macro is that it's May. We just had a Fed hike. We've had two Fed hikes despite this banking crisis. And this is the kind of thing I think we're going to look back from the future and say, okay, well, we probably should never do that again because what resulted was a significant depression, maybe recession. It's a key thing. Now, I say that. I don't like to say it as McGlone has been my nickname I've earned, but just point out the facts of liquidity and history, which I love getting on your program. We've never had a pump in liquidity like we've had up to that peak of money supply around 26% in 22 to down
Mm.
negative now. Never had that. And we've never had the dump like we've had now in terms of not only just money supply, but you're seeing it in bank deposits receiving. And just the lessons of history say we should expect some form of reciprocity in economic activity. Not complicated at all. So that means in the stock market, maybe just a normal 50% peak to trough correction. We've had that in the last two recessions. The key thing is in the leading markets, it's already happening, Michael. Like if I look at the most significant measure of heat, electricity, and fertilizer in this country. Natural gas has dropped to the same price as 1990. Significant deflationary forces. The Bloomberg Commodity Index is down 24% on a one-year basis. Copper has just broken down in the year, pumped 12%. There's still these little things. So I look at politics and everything. Yeah, the debt crisis is a pretty significant tree, but the forest is that we are tilting down towards a severe recession. Hasn't even started. And all the indications are right now, key question I'll leave you with is there's nothing I see on the radar at close that what can stop this downward trajectory at the moment.
Yeah, I think I'm not sure if you caught the Stanley Druckenmiller interview that he did recently at the blank on the name of the conference, but it was a super illuminating interview, I thought. And one of the things that he highlighted, or at least one of my takeaways, was just how uncertain of a period of time this is. And he's got 30 or 40 years in markets, but he's also a student of history as well, a financial historian. And he sort of drew the line to underscore how just unprecedented this particular period of time is. And one of the little sound bites that I kind of took away was he said, I could make the case in 3 years for either 8% inflation or deflation. And obviously, there's a huge amount of space in between those two predictions or outcomes. So, yeah, I would just love to, I heard you've been writing a lot about deflation. Is your sort of view that we're in a, all the forward indicators are,
Yeah.
pointing towards deflation, commodity prices are pointing that way. But then on the other side, there are some inflationary, you could make a bull case for inflation as well. So I'm wondering where you kind of come out on the long term there.
To me, the base case from a year from now is we will be in severe deflationary situation. And it's already happening in commodities. I pointed out it's happening in yields, already pointing that out. It's happening in virtually every indicator I look at. You look at here's one key fact. The producer price index around 2% now. Last year's peak was 18 or so, is dropping at the fastest pace in history. And that goes back to 1948. Now that's got a 2 beta to CPI. Typically it runs ahead of it. If CPI is running 5%, PPI is usually 10%. It's a 2 beta. It's going to be negative when we print the June number on July 13th, and it might have might somewhat mimic the lowest level ever, which was from July 2008 at 2009 at 6.9%, because it's the measure. Crude oil peaked the year before, and it bottomed that during the measuring period, and it's just what happened. The Bloomberg Commodity Index in crude oil peaked in June of 2020 of last year. When we measure PPI for June of this year, it'll be from the absolute peak. It'll be a negative number. If not, it'll be heading towards severely negative. So that's significant deflation. So let's take PPI minus Fed funds. It's negative. It's around it's negative like 2.5%. It's seriously contractory and recessionary. So here's the way I look at it. Knows all my indicators, everything I look at are showing towards severe deflation. I can point out, like I mentioned, commodities are down 24% on an annual basis. Copper's just broken down in the year. It was up on the year. The Fed we have a bank crisis. We had money supply contracting. Number one thing that Ben Bernanke pointed out when he wrote his essays on the Great Depression, there's one key measure that's on the cliff's edge for deflation. That's the stock market. So I think what's going to happen, risks of predictions, is the S&P 500 is right around 4 bid. I look at it as 4,000 bid. It's just going to go 4 offer and go down to 3. Now I say that I use these signals because I remember that in the trading biz. You'd see markets trading 1, 2, 1, 2. Gold just was offered at 2 for years and it just went 2 bid. And I think it's going to end up going 3 bid. I just see that happening with the fundamentals. The stock market, now the S&P 500 has been hovering around this 4 level. It's 4 bid. And a lot of indications are saying it should go 4 off. And once it does, I think it drops to 3. In a normal recession, that is your basically on a 1 to 10 scale, that is everything kicking in at a 10 for severe enduring deflation. Here's one key fact I'll end with is the Federal Reserve will just never ease with the ease they have in the past because of the lessons they learned from easing too much and inflation that resulted.
Yeah. So I like that you sort of zeroed in on stocks there. I don't know if you caught not that, we should be taking these people's words for gospel, but I don't know if you caught the interview that Paul Tudor Jones gave today. He doesn't do too many. And, this is the title of the Bloomberg article is Paul Tudor Jones says Fed hikes are over and stocks will rise this year. So if I were to make sort of the bull case for stocks here is like, let's just zoom out and look at where we are here. I think again, Stan Druckenmiller, the quote, before we started hiking rates was to cure every bout of inflation, we need to get Fed funds over CPI. And we've actually crossed that. We now have Fed funds in between 5 and 5.25, and inflation year over year came in at 4.9. So I think you could, make the argument that for the time being, we've slayed the dragon, right? We need to be concerned about all these forward looking indicators in terms of commodities and the Empire Index, which came in today, and it was a bloodbath. So that, we've sort of done what we needed to do in terms of inflation, and now we're going to maybe pause and then eventually ease. And over time, maybe like a year or two, that should be bullish for asset prices. What would you say to that argument?
So I have to admit, I confused Paul Tudor Jones and Druckenmiller's outlook. So that's the one I heard this morning that Tudor Jones is
Got it.
looking for the S&P 5 to be higher,
Got it.
be higher. So I don't know for sure. He might say that for other reasons. I think that's unlikely. I think that would be wonderful. That would be great if
Yeah.
that happens. But I like to point out, never forget from where you came. And to me, what's happening is we're in the beginning of the process of the overperformance, the outperformance in the U.S. stock market for about the last 11 years, just simply mean reverting. And what did it outperform versus the rest of the world in terms of MSCI, ex-US, exponential? It looks like the U.S. stock market in 1929, it outperformed GDP, well above GDP. It outperformed housing, well above housing, and above sales. So to me, that's the process of reverting. And for that to stop, yes, maybe it'd be wonderful we can have, but I still see earnings potentially, I hear them contracting on a 10% basis. And we haven't even started this recession. So I think that's an unlikely scenario without significant Fed easing. And that's what's changed. So I like to point out what's different from a lot of people who say, oh, okay, once the Fed's done tightening, the stock market to do well. I remember that cycle in 1994, but it has to, you have to remember from where we came. We were just so expensive, the US stock market. So I look at it as I used to, I was in the trading pits in the 80s. I remember um, the Nikkei peaked in 90. It still hasn't got above that level, the Nikkei 225. You look at the Euro Stocks index in Europe, I think it's the same price from 23 years ago, something like that. I could look at it in a second. So to me, that's the key thing. And that's why I rope in what's happening in treasuries. I look at it, this is also cyclical, and it's part of what's happening with demographics. Every boomer in this planet, when they saw that 2-year note go to 5%, they said, thank you. I mean, if they did it, then they weren't advised well. And what happened?
Yeah.
That was in March. And what's happened since then? So now it's offered at 4 at the moment. It's right around 4 yield. It's at 4 yield. I think it's going to go offered at 3, partly because we all realize, okay, we've had a great run. Time to check in and say thank you very much. And everything's tilting. I think we'd have to not get that recession. That's the highest probability since 1982 when you look at the yield curve. So here's another key factor. Look at unemployment. What, 3.2%, the lowest in how many years? Decades, 60 years or so?
Yeah.
There's never been a case of unemployment, and it's the stated goal of the Fed for unemployment to go higher. It's never been a case of unemployment troweling from such a low level without a severe recession, or at least a recession. And then I look at things like, why is the price of natural gas, the most significant measure of heat, electricity, and fertilizer in this country, dropped 80% and down to the same price as 1990? Why is copper giving them back all its gains? Those are indications on a global basis of a lack of demand pull. And what normally happens to commodities, humans create more of it for less. So I think good luck with that one. Sometimes people like that might not say exactly what their positions reflect for different reasons. You got to be careful with that. But I look at it, I'll end with this. I'm completely worried that crypto's the fastest horse in the race on the way down last year, and everything's been up this year. Like I said, copper's given that up. Cryptos are starting to give that back up. Will be one of the first indicators of everything starting to tilt back downward. And what's the stated goal of the Fed? Keep rates higher until they can reduce the ability for people to buy stuff. It's not what they said, but it's kind of my interpretation. It's also what Jim Bianco has said. And we haven't really reduced the ability to buy stuff. Here's one key thing I was shocked by too is
Yeah.
if there's indication it's still massive speculation in this space, and certainly in cryptos, the Fed doesn't like is this Pepe coin or whatever the heck that was. It feels to me a lot like Shiba Inu was in 21.
It does. Yeah. So I've got a question for you. So as you mentioned, I was just in Florida. And as one does when you're in Florida, just hanging around, you speculate about what the Fed is going to do and interest rates and stuff like that. And I was having a conversation with some of my buddies, and one of the things that I think it's super easy to forget is that there's a time lag in between kind of the cause and effect, especially in financial markets. And let's remember that all these bank failures were happening in the case of First Republic, that was in May. That was weeks ago, not even months. So when Chair Powell, I think in one of his, maybe not the most recent FOMC, but the one before, he mentioned the failure of the banking system as being roughly equivalent to another rate hike, right? And one of the
Yeah.
things I'm kind of trying to think through here is we knew for years, right? Not even just the last couple of years since COVID, but there have been basically rock bottom interest rates since 2009 relative to historical interest rates. So during that period of time, people probably baked those low interest rates into their financing and their business models, right? Now rates are higher, and the Fed has indicated that they're going to hold them above 5%. And when you couple that with the fact that banks are less willing to lend, I have to imagine there are some business models out there that simply aren't viable. It's more than just bank balance sheets that are impaired or temporarily illiquid. I would have to imagine that people made some bad decisions in these last 11 years. I would be curious if you agree with that, if you think I'm off base on that line of reasoning, or if you have any thoughts on what those
That's what
business models might be.
I've always enjoyed about how you capture what's so important sometimes in market, and I think it's via your very astute studying and reading and learning of history, and that is human nature will never change. And the human nature of having interest rates that low from that long and the reciprocity of shooting rates up the fastest pace in history. If you look at it on a log normal basis, it is. On a global basis, all these central banks, it's just, I think it's irrational to not expect normal reciprocity in markets and in what's happened with what people have done. Um, during that low interest rate period. So that's why I'm looking for one of the most significant economic resets of a lifetime based on normal cycles. And that to me is a key part of it. Um, so we're at the stage now is it's wonderful that we haven't rolled over that hard so far and that the stock market's bounced. But the key thing is everything's bounced. And the key thing to remember is history has proven that's always what happens. 1929, the stock market went down 50% to the peak in 1930 from the trawl 1929. It rallied 50%. And then the rest was history. We've done similar, not in high scale, but we are doing exactly what Ben Bernanke warned they did wrong during the Great Depression is cutting money supply. Everything was contracting on a global basis. That's still happening. We're just rug pulling liquidity. Now, I think I did enjoy meeting with David Altig of the Atlanta Fed in Miami recently.
Oh,
And
cool.
so it was the Miami Economic Forum.
Mm.
And I had a good 10 minutes conversation with him, and he pointed out, and even in his prepared speech, he pointed out, yeah, we feel confident that we covered the macro well by hiking rates, and then that the Treasury and whoever when the banking areas cover what happened with bank problems. And I think there's no way to judge that without the benefit of hindsight in the future, because this is the fact that they're tightening into a bank run. I think I'm just going to look back in history and say, what caused the bank run in the first place? What caused those deposits to leave? Rapidly rising interest rates and going to any place else you can get a decent return other than a bank deposit at zero. T-bills. I just look at that too, 4%. So that hasn't changed. And so I think it's irrational to expect what those to be just one-offs. Now, what's human nature do, as you learn from history, you always look at the most recent example. Bear Stearns in March of
Yeah.
2008. I remember well. I had a good friend who worked there. Um, but to me, what's different is the Fed started easing in SEP 2007. They're still tightening. So to me, it's still don't fight the Fed. Risk assets are elevated, like I mentioned on it. Some of the measures of the U.S. stock market still historically very expensive. Boomers are retiring and they're getting 4% of 2 out. And if they buy bonds, they might get some much more duration. I think that's where the rational money is going. Of course, we might get a default, which leaves gold.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Yeah, what do you think about gold? Gold has been one of those persistent. Yeah. It's been a tricky one, right? And I've pointed it out on this show. I'm not really a TA guy, but if you pull up the chart of gold, on a decade or so basis, you'll see this beautiful, cup and handle formation that's just emerging, and it's really found resistance right around the level where it currently is. And just when gold looks like it's about to break out, it seemingly never really does. So, what are your thoughts on gold at the moment?
Bull market that's ready to break out. I can't say that about virtually any other market I see. So gold at the end of the quarter settled its highest level ever. That was Q1. At the end of the month, if we settle here, it's be the highest month ever. And it's in the maximum disdain period, like you said, cup and handle. It's been frustrating everybody. I see it I just remember in the trading pits when you'd see a market that was offered at 2, and so many people, hey, I got 1,000 offered at 2, and finally it flips 2 bid. Before you know it goes 3 bid. That's what I think is going to happen to gold. I think it's going to do very much similar to what he did in 2007 and 8, was bumping up around 800, and finally, before you knew it, it was 1900. Just took a couple of years. That, to me, is the fundamental and technical situation for gold. The deepest pockets on the planet are buying gold, central banks. Don't want to fade them. One thing that's also notable about gold is gold ETF holdings have not picked up much. They're actually unchanged in the year, yet gold's up 10% on a 12-month basis. And these ETF holdings haven't moved. So I think it's not even retail in the spaceship. I think they're going to realize this is an asset that over time versus a dollar price always goes up versus a basket of fiat currencies, gold price always goes up, and it only goes down after it goes up a lot. It's just the way it works, because you just can't, it's that unique. The thing is, in the last I'd say 5-10 years, it's had decent competition from Bitcoin. So the way I look at gold is I fully expect gold to pop to 3,000 at some point. I don't know when I try to be careful. An equivalent rally that it did during the, starting from 7 to 11 or so, was to get towards 5,000. I don't see what stops that. That's in US dollars. Now it's made highs in the euro, made high in the yen. But I don't see it. To me, it's imprudent to hold gold anymore without some Bitcoin in that space. The key thing is, if you look at that Bitcoin to gold ratio, it's been up over time. It's starting to tick back down. It's bounced. I think it's going to back down again, because I see gold as it's outperforming Bitcoin on a 12-month basis. And if I'm right about this correction in the equity market, which is my base case, that's going to drag down all risk assets. Cryptos are some of the riskiest assets. It's just Bitcoin's the least risky, but gold I see is, I don't see what stops the rally. So I recently was in New York. I was at a mining conference. I compared gold to platinum and palladium and silver, and it looks bullish versus all of them, particularly silver. And people are, get on these tangents to get a lot of the bugs there about being bullish silver. I'm like, well, there's a problem with silver. If we get towards recession, it's going to follow copper. That's the key thing. Gold's been appreciating versus silver over time, except for maybe 10-year increments. And central banks are buying gold, not silver. So I just don't want to mess with that trend. So gold to me is one of the most enduring bull markets I see ready to continue breaking out. And I see things like copper continue to drop. And it's all going to be predicated. The key trigger, I'll end with this, for gold to break out is when people start realizing they're not going to get that 9 to 10% annualized return they got in the S&P 500 index fund they got the last 10 years. When they start realizing, well, maybe I'll give back more of that. Maybe we're going to severe deflation. And I don't see gold, to me, as a top potential performer to do what it did from 07 to 11.
You're absolutely right that central banks, especially, are buying more gold than they ever have been. What do you make of that trend? And do you sort of buy into this idea? This kind of fits in with this narrative about the U.S. failing as a reserve currency. People are worried about what happened to Russia when war broke out with Ukraine, the freezing of the central bank reserves. What do you think about that whole narrative?
I think those are trees in the forest of the dollar domination. I mean, I've heard it so many times in my career, and now's a good time to beat up on the dollar. Um, but I like to use, if you measure the dollar versus a basket of fiat currencies, just to use the New York Fed dollar trade weighted dollar index. The only time the dollar versus a basket of fiat currencies goes down is after it goes up a lot. And we went up a lot recently. It just backs up and then goes back to trend. there's no better example of a fiat currency on the planet. Maybe Swissy in the short term, but if the U.S. unveils its veil of protection of Europe, Russian tanks can go right down to Switzerland. I mean, it's that significant for the dollar. And I like to, I mean, that's macro, the deepest markets in the world. I mean, this discourse we're having about the debt ceiling, it's horrible, but it shows our strength. It just, we'll beat the shit out of each other. I'm sorry, I got to watch that. We'll beat ourselves up. And it just shows how strong we are once we come to the right conclusion, as Churchill says. You're not going to see that in China. It's whatever Mr. Z says. But I like to use one specific example for the dollar that has really kept me bullish the last few years, and that's cryptos. The most widely traded cryptos are dollar tokens. That
Yeah,
happen
stable coins.
completely organically. Yeah, to me, crypto dollars, I call them, because 'cause they're just like euro dollars. And I remember having this debate with not a conversation with our Audrey Chill Freeman, who's our equity strategist, I'm sorry, FX strategist, and pointing this out. And we came around that, well, that's a significant organic sign on a global basis that there's no better base currency on the planet, still isn't, than the dollar. Now we're going to see some of this trading in other currencies. We should see that certainly between, let's say, the yuan and the ruble. And I like to say, well, good luck with that one. Good, try it all you want. And then where are all those reserves going to end up? Obviously, some form of physical assets like gold, which is what they're doing. And eventually, as Saifedean Ammous suggests, maybe Bitcoin. But I don't. I just like to point out, once we get past this budget impasse, and just imagine with the value of the Dow you really see when you have autocratic leaders like just happen invade foreign countries. Then you realize, well, okay, do we really want to deal with the risk of Mr. Putin or Mr. Z? Or maybe America's not perfect, but it sure has this rule of law that helps us do what we're doing now, be able to say whatever we can. I'll give you one example. So we have an issues now with Bloomberg. We had one of my colleagues in Bloomberg who was technically detained for a year because she was in China and she wrote something unpleasant that the Chinese authorities agreed upon. So I think what's happening is we're seeing this major shift now, and the most of the rule of war of law in the world realizes that dollar is the only fiat currency, and it's got to be replaced with something else, but not another fiat currency. I mean, just good luck with that one.
What would you say though to the again just like the historical perspective here? There have been world reserve currencies in the past, right? There are kind of like at least six of like the
Yeah.
great periods, and a lot of these when like these reserve currencies at the time would even sound funny. It was like Portugal, the
Well,
Netherlands, right? Countries you wouldn't even think of now to be in the running or in contention. Maybe even the most recent one, which is the pound, right? Pound sterling. It even evokes
yeah,
images of like being hefty and weighty and all that stuff. I'm sure that Churchill wasn't particularly worried at a certain period of time. It would have sounded crazy, right? What's going to replace pound sterling? So at a certain point, there is historical precedent that this stuff tends to not last over a period of time. And then also just the one thing I just haven't been able to like fully convince myself of is if I was a leader of if I was Putin or if I was Xi and I just watched an enormous portion of my assets get seized and I viewed myself in competition with the government, it wouldn't happen today. It wouldn't happen tomorrow, but I would start planning. I would start contingency planning. Is that what would you say to those like kind of maybe longer term arguments?
right now there's still only one major currency, and it's going to depend on how it works, what works out with this war and everything. But and there's one alternative. It's gold, but it's also potentially Bitcoin. So that's why I long term I have to, I don't know exactly what's going to happen with the dollar, but I think I do one thing I want to point out. When people point out about the demise of and how the dollar's declined 97% over a certain period, something like that, they always forget to include that interest. Right now, I'm getting
I
5% of my T-bills,
Yeah, I'm with you on this.
and I'm not getting that with Bitcoin, and I'm not getting that with gold. But it's just funny how people bend the narrative to fit their views. And so that 5% you're getting that UST bill is pretty darn good compared to um, gold and even the stock market, I think, right now. So I'm not worried about. To me, it's the bigger picture, technology and macro, and what replaces it. And I know you've studied the lessons of history. And I look like, we've had this discussion before. I look at, you mentioned the Roman Empire in 1,000 years. I'm like, okay, US, maybe we're what, 300 years in, give us another 700 years. I just can't wait to
Yeah.
hopefully live long enough to see how this period works out with these two autocratic leaders who are very completely, I mean, I look at China right now as somewhat of a combination between peak Japan and peak Soviet Union. And maybe somewhat worse with everything I read, everything I see and from colleagues, everything is just the recent pushback on consultants. Like, good luck. We're the benefit, we're the value to our countries. We criticize everything, we make ourselves better. So I don't see how they're going to do well in a world that's moving so fast in technology. And in this technology that's moving the fastest adopted the dollar as its base layer. I look at dollar tokens and just hope the US doesn't mess up this transition to a digital world.
You
Yeah.
mentioned in your last note that there's a managed money, so hedge funds basically are record net short U.S. Treasury bonds. Why do you think that is? Is that debt ceiling related?
I think it's related to that. It's also what happened in this cycle. Last time this happened was around 2018 when I like to use it versus open interest. It's about the highest ever. When the 10-year yield was around 3%, and then COVID hit and everything, and it dropped to what, near 50 basis points. I think it's going to do the same. But the key thing I like to point out is um, that is very bearish for yields, bullish for prices. Why it's happening, I think it's related, but a lot of it's probably basis trading. People are doing the cash versus futures. I used to trade basis. I used to have hair too. So you short the futures and you're buying the cash and getting. So there's certain nuances in there. I just don't. I used to know very well. I don't track anymore. I think that's a big part of it. The fact is, to me, the indications are the shortest ever for bonds, tens, and fives. Managed money net positions, basically hedge funds, which to me is not so much bullish for treasuries, but it's just as bullish for gold because you look at these same kind of things in gold, and you don't really have that. And gold is so big and physical. It's not dominated by futures versus treasuries. When I was in the pits in the 80s, the guys in New York, this was in Chicago, we used to get upset that, oh, you guys are driving a market. And that was well before there was dominant futures. So I look at this as very bullish for gold. It's a good indication that you should be buying long bonds. And this is just an indication for these offside positions and buying gold. Because the last time that when these things happen, when yields drop because people are covering their shorts and pushing prices up, it's usually an indicative for obviously bond prices and gold prices are going out to go up. And maybe it's a hedge on default, but I think it's more basis related.
Yeah. And what do you think about yields going forward from here? So we've got the yield curve is still inverted, right? At least looking at the twos and tens. Additionally, if you look out over the course of the next 10 years, I think the CBO, the Congressional Budget Office, they've forecast a deficit of between 1.5 and $2 trillion per year. So that's a lot of new issuance coming out into the bond market. And I'm curious if you think that's going to move the needle in terms of yields at all.
There's a picture of me I have from a newspaper from 1994, 3, I think it was, pointing out how high the deficit was and how bad that was for yields. Um, and so I look at it as we're all turning Japanese. And I think the 10-year note yield that was 4% bid recently when offered at 4, now it's trading 3.5%. Now it's going to go offered at 3, offered at 2, maybe down to 1. I think yields are going to drop in a significant deflationary recession, drop a lot. And yes, deficits will go up. And let's look at the example of Japan. Now, at some point, there's going to be an unwind of all that. But in a typical normal recession that's deflationary, and I'm seeing all the signs of commodities. I mean, natural gas is collapsing. Copper's going down, crude oil's going down, even all the ags are gonna go down a lot. I can explain that later. Yields will decline. So, 3.5% 10-year yield versus Fed funds at 5% is clear recessionary. Our Ira Jersey, our chief, interest rate strategist is less he's calling for a bullish, steepener, which means at some point the Fed's gonna ease, but not yet. I'm just way too early. I was wrong about buying bonds, but now I think this is gonna be one of the best buying opportunities in a lifetime, and I think yield's gonna drop a real lot into recession, and that's also based on the S&P just going from what's a 4 handle in front, 4,000, drop towards 3. So 10-year note, yield dropping to 2 this
Yeah.
time next year, maybe. We'll see. I mean, what stops that? Fed easing will help tilt yields lower, but if the Fed delays easing as we get towards recession, it's gonna be more depression.
Yeah, you know what? I tend to agree with you, Mike. And one thing that I mean, I've referenced it a whole bunch on this show before, but Jack Schwager, his sort of seminal Market Wizards book, that was 1989, right? That was 4 years, I think.
I knew a couple of those guys. I remember Charlie D was one key guy in there, Charlie D. Francesco. sorely passed away, but learned a few lessons from him.
R.I.P. Charlie. But in many of these interviews, right, they're talking about the same thing that you and I are talking about now.
Yeah.
You could basically repaste the figures and the names of the politicians
Yeah.
that we're talking about here onto a conversation that was happening, 30 years ago. So I sort of tend to be in that same boat. And I also think, one of the arguments that oft gets overstated is, well, who would buy bonds if they're yielding 0%? Well, as it turns out, banks. Banks will
Yeah.
buy them because they have to,
Yeah.
So I
Yeah.
I, I agree with you.
Well, it's maybe sometimes better if we don't disagree. So let's look at some of the indications that keeping the Fed. I wanted to mention this. You look at measures of CPI. I just love to use that owner's equivalent rent level. It's the highest ever at 8%. There's
Mm.
only one way for it to go down, to drop a lot. And why should it go down a lot? Well, we just had the biggest pump in liquidity ever, the biggest pump in housing prices ever. And it's just starting to go down early right now. Just wait till it accelerates. And what stops it from accelerating? Aggressive Federal Reserve easing is typically what it takes, and they're not going to be doing that.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our Permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. If you've been in crypto for a while, you know that bear market conferences are the best conferences because those are the ones that all the alpha's at. This year, we've got a phenomenal lineup of speakers, and the topics that we're covering are insane. We're going to be talking about ZK Tech, roll-ups, account abstraction, MEV, app change, the whole suite of stuff. I cannot wait myself. So, because you're a listener of this podcast, you're also going to get a discount. Type in PODS20 and you're going to get 20% off your ticket. Click the link at the bottom of this episode and go get it now because prices go up every 2 weeks.
The demographics thing has always made an enormous amount of sense to me
There you
when
go.
it comes to deflation. But let me, just in the sake of debate here, let me push back and give you some pro-inflation arguments and just see what
Yeah,
you do with them or what you'd respond.
I
So
enjoy these.
awesome, great. So one of the things that I think is Pippa Malmgren that initially made this observation to me, and I've just thought a lot about it, is there's a psychology that comes with inflation that's sometimes hard to actually pin down. And, we love to give our politicians crap for blaming corporates, but corporates have done pretty well. They've demonstrated quite a bit more pricing power. And I think that's just because they all sort of woke up and said, hey, people expect us to raise prices. Might as well raise prices. And so far, they've sort of gotten away with it. And that psychology has gotten entrenched. Additionally, when you look at how politicians handle these periods of time, right? There is this great big overhang that we eventually need to figure out, right? Which is that our debt is growing far faster than our GDP. Maybe it is Japanification. Maybe we wake up in 10 years or 20 years or 50 years, but I do believe at some point something ends up breaking there. And I do feel like one of the way that we're going to get out of that basically is, I know you said default is an oxymoron here, but I feel like inflation is a sort of a soft default that actually feels like a not too bad option. And then the last thing is just, again, I want to be a little careful about narratives here, but this whole multipolar world, I do think on the margin, we will move supply chains out of the East. I don't know if that means that
It's
we
already
will
happening.
I don't know if that means I don't think we're going to put production back in the US, but there'll be some degree of nearshoring with slightly more expensive labor markets. And even in the meantime, there's just going to be a whole bunch of friction. And I feel like that drives up wages and that drives inflation as well. So honestly, when I look out into the 10-year future, I see all these inflationary impulses as well. And I'd love to know what you think about those.
So there's only one way I think we're going to have inflation in the next 10 years, and that is if we debase our currency a lot. I mean, as Milton Friedman said, I think inflation is a currency phenomenon always. So what is a 3D printer? I had a good colleague, a friend of mine I met recently, does industrial design and pointed out, oh, I've got 3D printers in my basement. I put out so many of these widgets, whatever a day. I used to import those from China. It's not happening
Yeah.
anymore. It's just so deflationary. It's
Yeah.
I love that case. You cannot use the 70s and stuff as an example. I feel right now we're heading towards the most significant deflationary period in our lifetimes. And that's going to depend on if we debase the currency, if the Fed eases a lot. If they stay tight like they are now, all the lessons of history point to, why measure inflation on a 12-month basis when you look at a 120-month basis, 120-month basis, 10 years, it's collapsing. It bounces, collapsing. There's good reasons for that. One key reason, when people start losing jobs, that psychology is just a tree in the forest. You
Mm.
can't, you ain't got money. When money disappears from the system, you stop the ability of people to buy stuff. You ain't got money, you can't buy stuff. And that's, again, Jim Bianco. So I like to point out, I used to remember seeing this in a trading pit. Sometimes money just goes poof, it disappears. And that's what I'm afraid of it's happened to commodities. I'm afraid of in the equity markets. If we get that little poof, we get the normal correction, there won't be that ability to buy stuff, to buy condos in Miami. As I look over at the condos in Miami or land in the Midwest, um, unemployment will be the bigger problem. Give me a
Yeah.
job. I need money so I can buy stuff. I mean, depressionary type of inflation is what I'm afraid of, but mostly because of rapidly advancing technology. The key thing is that all the major head trends in history point that way. And unless we really print a lot of money and do what we did last time, why did we get that inflation? Well, we bumped up the money supply by 26%, of 40% is part of it. And now we're taking that away. Just that's the way it's always worked. The biggest pumps, booms, and busts in history have always been back of liquidity that goes away. And we're in that process of taking that liquidity away. So I'll use that one example. We only have 75 years of history, and the producer price index has never fallen as fast as it is now in the last 10 months, ever.
Yeah.
Okay, so what stops that, Michael? Lower plateau. You got to get
Mm,
real low or pumping money. Those are only two key factors.
right. And so I agree with all that, but I think that second point still stands about the problem with our deficit. And I know people
Oh,
have been
yeah,
talking about this forever.
I
I
know.
hear
Yeah.
because I do think that's the, I mean, all right. So even in the short term, right? If you think about our bank system as actually a liability of the US government, which I do think that that's ultimately the lens that they would look at this, which is we don't want people to be worried about bank deposits in the United States. The insurance fund for the FDIC is $125 billion. That is not nearly enough to insure, right, the banking system. Ultimately, you could sort of view any shortfall in the banking system as a direct liability of the Treasury. So that's like very short term. But even like moving out slightly longer term, what do we have? We have entitlements. And the entitlements we basically promised are going to grow at a 7% rate per year. That's the societal growth expectation. The pension shortfall thing, again, there have been headlines for 10 or 20 years. My co-host on the show, Mark Yusko, talks about it all the time, but we're going to be short there ultimately as well. And then on the long term, we have this big debt overhang. So it's like on every time frame that I kind of look at, there's this need to print money. And then if you just look at how's the government reacted to basically, look, I'm 29 years old. Every financial crisis that I've ever paid attention to has been met the exact same way, which is immediately to slam on the money printer. It's my entire financial memory. And I could be wrong. I mean, they could break that trend and I could be wrong about that. I could be overweighting it due to recency bias or whatever, but that's what
So
the conclusion I ultimately come to.
lessons of history. I'll give you some of my lessons. So first of all, I remember trading JGBs in the early '90s, and everybody I spoke to on the phones. I was trading sales. Everybody spoke to.
Yeah.
I'm short and I'm happy. Yeah, when you see so many people lose money on the same narratives over time, like this commodity super cycle, I saw so many people lose jobs and money in the last commodity super cycle that failed. And recently I was on this call and the guy said, I've been trading stocks for 10 years and I'm bullish. And I'm like, okay, well, you got to live through a bear market where they go down and stay down. And the only time they really get bullish and really bear markets is when it feels like they're never going to go back up again. And a lot of people say that. So I just have learned those lessons. I've seen it. I hope someday it all will work out. But there is a I've seen so many people short treasuries on greater deficits and lose money that I gave up on even mentioning it. So
Mm.
I look at it. The deficit is it's the opposite. Here's a fact that in this country, particularly in Japan, but in this country where the base currency is, the greater the deficit, the lower the bond yields. Just this trend. It has been lasting for many years, and I'll go with it until proven wrong for a good reason. So I guess I'm kind of a sissy, a trend's your friend, huh?
Hey, I mean, look, it's worked for a really long period of time. That to me is naturally counterintuitive, but clearly there's a rhyme and a reason, and it works. And maybe the intuitive reason first that it wouldn't work like that is the more bonds there are, the more issuance, the higher yields ultimately need to be. I guess you could take the other side of that argument is the more debt that I need to issue, I need yields to be lower so that I can afford to issue that debt. Therefore, I will make yields lower. It works
There's
both
part of
ways
that,
actually.
and there's part of that, and there's also if a lot of your debt is owned by non-sovereign or what they say foreigners, what's their vested interest? probably for that debt not to default and to, for
Yeah.
those yields that continue to decline, you make the money on the duration. The T-bill's a different story, but I look at it. So that's where I come to. There's a default in there, and that is, well, what is definitely some point when this can't is unsustainably the unsustainable part kicks in, is it's still favorable things like gold and Bitcoin.
Yeah. Yeah. So let's maybe in our closing minutes here, I would love to just get we sort of talked around all the issues that I was hoping to discuss with you today, but your sort of outlook on the S&P or stocks in general for the next year, pretty bearish, right? So maybe down to 3,000 S&P sort of range.
Yeah.
How do you think if I had to put the screws to you and ask you how you think Bitcoin, gold, and let's say the long bond like TLT, where do we end the year at?
So I can't really put where we end the year. I can put where I think they're going. So I
Yeah.
think, like I said, I think end of the year is going to really depend. Everything will tilt if we get this rollover in the stock market. If the biggest surprise for me will be with that, if that doesn't happen, then I have to reassess a lot of my views. So if the stock market, let's put it this way, my base case is going to 3,000. Bitcoin's going to go down. I don't know how far. It might make a new low. Cryptos will go down real hard. And we're going to purge some of these 24,000 cryptos, and get rid of some. They're just silly. But Bitcoin and Ethereum will come out ahead. So my base case is that's going to happen. S&P 500 goes to 3,000. Yields drop a lot, maybe by the end of this year, but next year will be more enduring. It'll just continue that. And I think we're supposed to get one of those periods like we did. I remember from 2002 to like 3 and 1 and 4. It took forever you have to get through this enduring period of a severe, I would say, purge of assets. To me, that's my base case. The biggest surprise will be if we don't go down the stock market. I don't fully expect Bitcoin to outperform that case. So there's kind of a win-win.
Yeah.
But that would be kind of strange, I think. And historically, it will prove that, so the rules and laws of liquidity and pumps and dumps and cycles in markets may no longer apply. I'd be kind of concerned about that.
Yeah.
So I got to take it case by a day at a time basis. And by base case to me is pretty significant recession. Here's how I'll end with. The market's basically already priced for a soft landing. David Alteg even said that when I spoke to him. It's priced in. So I look at simplistically as an option market person when I used to be on phones with customers, and when we went off phones, creating strategies. The value in a strategy is to go counter to that, because you can structure an option position where you can make 10x if what's already priced in doesn't happen. So that's why I'm kind of leaning. I'm sticking with that in my outlooks, and I'm looking for key leading, always looking for indicators. So what happened last week? Copper breaking down is kind of going the way I was expecting. Bitcoin and Ethereum peaking. Bitcoin around 30,000. Ethereum around 2,000 is going that way. 10-year note yield dropping. It could not stay above 4% very long, dropping down. 2-year could not stay above 5%, despite Fed tightening. Could not do it. Offered back at 4 now. Everything's leaning that way. And copper was, I think, the big one last week when it broke down. So I'll end with this. The key price, here's some simple facts. The price of copper is $2.75 on a pound. If you take the S&P 500, divide by 1,000, it's almost exactly the same since 2016. So right now, copper's broken down. It implies S&P 500 is 10% overvalued. Maybe that's changing. I don't know. But what I'm afraid is going to happen is what's happened in natural gas, is everything is going to go back to the averages they were right before COVID. Natural gas did it. Crude oil, that's around $57 a barrel. Nothing, not a big deal. In copper, that's around it's 375 now. It's around 275. So that implies the S&P going down to below 3,000. That's what I think is going to happen.
Yeah. Mike, it's always a pleasure to get you on here. I love our kind of mix of what's going on in markets today versus the historical bent is always a ton of fun for me. And you put out great work as well at Bloomberg. So if folks want to follow you, find out more about the work, subscribe to the work that you do, what's the best way to do that?
LinkedIn, you can find me, Mike McGlone Bloomberg, and Twitter, Mike McGlone, at Mike McGlone 11. And one thing I want to point out is I want to thank you for what you do, because to me, what you do by putting out your thought-provoking and your discourse every day is what's really changed in the world. I can be at the gym or working out and listen to something like your podcast, which I listen to you and Mark all the time, usually when I'm working out.
Thanks.
But that's the value of human intellectual ability, I think that's rising, and certainly free market and open information. I don't think we're going to look back from the future and say, "Oh, that was a revolution in us raising our bar of knowledge." And to me, that's what's happening when you help make that happen. So I appreciate it.
Thanks, Mike. I really appreciate that. All right. With those nice words said about me, I think we can end it. Thanks, Mike.
Great.
I'll do it again
Cheers.
soon. Cheers.